I'm Ivan Gruhl, Chief Investment Officer with Avantax. Today we'll provide a market update for November. We'll start with a recap of returns for October, and then shift to an update on the Federal Reserve and the challenges of the government shutdown, corporate earnings, and market concentration, and our outlook going forward. October proved to be another rewarding month for investors, as the S&P 500 posted its sixth consecutive month of positive performance, while all major indices finished the month in positive territory. The S&P 500 tacked on nearly 2.3% in total return during the month, while the Russell 2000, the small cap index, finished the month higher by 1.8%. Overseas, emerging markets led the way, rallying more than 4% in total return, while the International Developed Index gained about 1.2%. So far this year, emerging markets are leading the way, higher by nearly 34% in total return, followed by international developed markets up more than 27% year to date. Here in the U.S., the S&P 500 is on pace for another very strong year as well, up more than 17%. In small caps, the Russell 2000 index has rallied about 12.5% after shrugging off a less than stellar start to the year. October brought another month of strong return in bonds, with falling interest rates providing a boost for both taxable and municipal securities. Taxable bonds, as measured by the Bloomberg U.S. Aggregate Index, gained 0.6% in October, and municipal bonds continued their recovery, up more than 1.2%. So year-to-date, the taxable bond index is up about 7% in total return, while the municipal bond index is higher by nearly 4%. Looking ahead, we continue to believe that bonds offer a compelling opportunity for investors to lock in relatively attractive yields and avoid reinvestment risk associated with shorter-term investments. As the Federal Reserve continues down its path of lowering interest rates, we expect to see further downward pressure on yields offered by short-term investments like money markets. On October 29th, the Federal Reserve concluded its penultimate policy-setting meeting of 2025, voting to enact a second consecutive quarter-point rate cut. The move lowered the upper bound of the federal funds rate from 4.25% to 4%. The committee was divided in their view, as new member Stephen Moran preferred a larger 50 basis point or 0.5% cut, and another voting member, Jeffrey Smith, voted for no change in rates. Fed Chair Powell's post-meeting remarks introduced further uncertainty, as he stated that a December rate cut is not a foregone conclusion. The shift in tone rattled the bond markets, with rate cut expectations for the next meeting in December falling from a 93% probability to 65% following the announcement. With the government shut down since October 1st, assessing the current state of the U.S. economy has become even more challenging for the Fed, with key economic indicators produced by government agencies delayed or postponed. With the exception of a delayed CPI inflation report, it's been over a month since we've received any economic data from the federal government. For the markets, the shutdown has largely remained an afterthought, as investors have plenty of earnings reports and private sector indicators to sift through. On the earnings front, results have been stronger than expected, with about 2/3 of S&P 500 companies having reported third-quarter results. The U.S. index is on pace to post year-over-year earnings growth of more than 10%, which would mark the fourth consecutive quarter of double-digit earnings growth. A significant portion of the earnings growth can be attributed to the technology sector, which has seen its share of the broader market increase over the past several years. This next chart shows the concentration of the top 10 companies by market capitalization in the U.S. These companies now account for about 40% of the S&P 500. Historically, the top 10 companies have accounted for approximately 20% of the index. As we enter the last 2 months of 2025, we believe the recent market momentum could continue into year-end. However, we note that the markets have become increasingly vulnerable to a potential shock as valuations, concentration, and investor exuberance continue to mount. We continue to stress the merits of diversifying portfolios, particularly in an environment where many of the largest companies account for such a significant portion of the U.S. markets. After many years of strong returns in stocks, we believe this is a good time to review your asset allocation to ensure you are still positioned appropriately to meet your long-term goals, objectives, and risk tolerance. So that's what we have for this month. Thank you for watching and have a great day.